What if I told you that investing, the actual mechanics of building long-term wealth, can be explained completely in about 4 sentences? Buy a low-cost index fund that tracks the entire stock market. Don't sell when markets drop. Wait 20 to 30 years. That's it. That is the complete strategy that has built more ordinary millionaires than any other approach in history. 4 sentences. No spreadsheets. No financial degree. No Bloomberg terminal. So why does it feel so complicated? Why are there thousands of hours of financial content, hundreds of investment products, armies of financial advisors, entire television networks, and a $50 billion financial media industry, all dedicated to something that can be summarized in 4 sentences? Because simple doesn't sell. Because confusion is not an accident. It is a product, deliberately manufactured, carefully maintained, profitably distributed, to the tune of hundreds of billions of dollars per year, extracted from ordinary investors who believed they needed help understanding something that was never actually that complicated. The financial industry is one of the most sophisticated confusion manufacturing operations in human history, and today, we are going to walk through exactly how it works, who profits from it, what it costs you, and the 4 sentences that make almost all of it completely unnecessary. Let's pull back the curtain. Let's start with the scale of what we're talking about. The global asset management industry, the business of managing other people's money, oversees approximately $120 trillion in assets as of 2025, according to data from McKinsey's Global Asset Management Report. $120 trillion. The fees charged on those assets, typically 0.5% to 1.5% annually for actively managed funds, generate approximately $600 billion to $1.8 trillion per year in management fees. Every single year. Paid by investors to managers for a service that the majority of those managers demonstrably fail to deliver because most actively managed funds underperform simple index funds over time. Let that sink in for a moment. The industry charges hundreds of billions per year for active management, the attempt to select investments that outperform the market, and the data on whether this service delivers value is overwhelming and consistent. According to S&P's SPIVA scorecard, the most comprehensive ongoing study of active fund performance, over 15 years, approximately 92% of large-cap actively managed funds in the United States underperform a simple S&P 500 index fund. 92%. Not a few managers underperform, not half. 92% of professional fund managers, with access to research teams, proprietary data, advanced technology, and decades of experience, fail to beat an index fund that requires no management whatsoever. And yet the industry continues to charge for this service, and investors continue to pay. Why? Because most investors don't know this data exists, because the industry has no incentive to publicize it, and because the complexity surrounding investing makes it feel like you need professional help, even when that professional help costs you money while delivering worse results than a $10 per month index fund. This is not incompetence, it is architecture. The complexity exists because the complexity is profitable. The financial industry uses specific, identifiable tools to manufacture and maintain the confusion that keeps investors dependent on high-cost services. Understanding them removes their power entirely. Weapon 1: Jargon proliferation. The financial industry has developed an extraordinarily dense vocabulary: alpha, beta, Sharpe ratio, duration, convexity, basis points, tranches, structured products, derivatives, that serves primarily to make simple concepts sound technical and inaccessible. Consider what alpha generation through dynamic asset allocation actually means in plain language: trying to beat the market by moving money around. That's it. The jargon doesn't add meaning, it adds mystique. It signals expertise. It creates the impression that you are operating in territory that requires guidance. Every industry develops jargon, but financial jargon is uniquely profitable because it creates the perception that ordinary people cannot participate without interpretation, without a paid intermediary who speaks the language. You don't need to speak the language. The language was designed to exclude you. Weapon 2: Complexity theater. Walk into any financial advisory firm and you will be presented with sophisticated-looking materials, asset allocation charts, Monte Carlo simulations, correlation matrices, risk-adjusted return projections across multiple scenarios. This material looks like deep analysis, It is largely theater. For most ordinary investors with straightforward financial situations, regular income, saving for retirement, no exotic tax situations, the optimal portfolio is genuinely simple. A few low-cost index funds in tax-advantaged accounts, rebalanced annually. The complexity exists not because your situation requires it, but because simplicity cannot be charged for at $200 to $400 per hour. A financial advisor who told you, buy VTI in a Roth IRA and leave it alone, would be telling you the truth. They would also be explaining their way out of a client relationship. Weapon 3. The illusion of market prediction. Financial media runs on the implicit promise that someone knows what the market will do next. The pundits, the analysts, the strategists. Their presence on television, their confident predictions, their detailed explanations of why the market did what it did yesterday, all create the impression that markets are knowable, predictable, navigable by the sufficiently informed. This impression is false, and the evidence is not subtle. CXO Advisory Group tracked the predictions of 68 prominent financial gurus between 2005 and 2012. The average accuracy of their predictions, 47.4%, slightly worse than a coin flip. The market is not predictable in the short term. This has been demonstrated repeatedly across decades of academic research. Eugene Fama won the Nobel Prize in Economics in 2013, largely for formalizing this insight, the efficient market hypothesis, which shows that publicly available information is already priced into markets, making consistent outperformance through prediction essentially impossible. But prediction makes for compelling television, and compelling television attracts advertising dollars. And so the illusion of predictability is maintained, not because it reflects reality, but because it generates revenue for networks, attention for analysts, and fees for managers who position themselves as navigators of an unknowable market. Weapon 4. The active management myths. The story the industry tells is that skilled managers can identify undervalued investments, avoid overvalued ones, and navigate market cycles in ways that produce better outcomes than passive index investing. This story is compelling. It appeals to the intuition that expertise should matter, that a team of brilliant analysts with proprietary research should be able to outperform a simple formula that just owns everything. But the data consistently and comprehensively refutes this story. The SPIVA data is not the only evidence. Morningstar's active-passive barometer, published annually, consistently shows the same pattern. William Sharpe's arithmetic of active management demonstrates mathematically that active managers as a group must underperform the market by exactly the amount of their fees because they collectively own the market, minus their costs. This isn't opinion, it's arithmetic. Active managers collectively own the market. They trade with each other. For every active manager outperforming, another must be underperforming by exactly the same amount. The net result for active investors as a whole is market returns minus fees. Fees guarantee that active management as a category underperforms passive investing as a category, every time, mathematically, by definition. Weapon 5. The product proliferation strategy. The investment product universe has expanded dramatically over the past 30 years. There are now over 8,000 mutual funds in the United States, more funds than there are publicly traded stocks. There are over 3,000 ETFs. There are annuities, structured notes, alternative investments, private equity vehicles, hedge funds, and hundreds of other products at various price points. This proliferation is not driven by investor need. It is driven by fee generation. Each new product represents a new revenue stream. Each new product adds apparent complexity to the investment landscape, reinforcing the impression that navigation requires expertise. The optimal portfolio for most ordinary investors has approximately 2 to 5 holdings. The industry offers thousands, each with its own fee structure, its own marketing material, and its own contribution to the impression that investing is complicated. Weapon 6. Fear-based marketing. Financial products, particularly insurance-linked investment products, annuities, and actively managed funds, are predominantly sold through fear. Fear of market crashes, fear of outliving your money, fear of making the wrong choice, fear of not understanding enough to manage your own finances. Fear is the most effective financial sales tool available because it short-circuits rational analysis. A frightened investor does not evaluate whether the fee is justified. They evaluate whether the product makes them feel safer. Insurance companies and annuity providers specifically target this vulnerability. charging substantial fees for the emotional comfort of guarantees that, when properly analyzed, often cost more than they protect. Let's quantify exactly what the confusion industry extracts from ordinary investors. The fee tax. The difference between a 1% annual expense ratio, common in actively managed funds, and a 0.03% annual expense ratio, available in the lowest cost index funds, is 0.97 percentage points per year. That sounds trivial. Over decades of compounding, it is catastrophic. $500 per month, invested for 30 years at 9% net return after a 1% fee, approximately $940,000. $500 per month, invested for 30 years at 9.97% net return after a 0.03% fee, approximately $1.15 million. The fee difference costs approximately $210,000 over 30 years on a $180,000 total contribution. You paid $210,000 for management that, in 92% of cases, produced worse returns than the cheap alternative would have. The advisor tax when it applies. Investors who don't understand what they own make worse decisions when markets become volatile. They sell at bottoms, they buy at tops, they move to cash when fear peaks, which is typically when the best buying opportunities exist. DALBAR's annual quantitative analysis of investor behavior, published annually since 1994, consistently finds that the average equity fund investor dramatically underperforms the funds they invest in, not because the funds are bad, because the investors make behavioral mistakes, buying and selling at the wrong times. In their most recent analysis, the average equity fund investor earned approximately 6% annually over a 20-year period in which the S&P 500 returned approximately 9.8% annually. The gap, approximately 3.8 percentage points annually, is called the behavior gap. It is the direct cost of not understanding your investments well enough to hold them through volatility. On a $100,000 portfolio over 20 years, the behavior gap costs approximately $238,000. Not fees, not bad fund selection, just behavioral mistakes driven by confusion and fear. The complexity that the industry manufactures does not just cost you fees, it costs you the behavioral stability to hold through declines. It costs you the confidence to stay invested when headlines are terrifying. It costs you the understanding to know that doing nothing is often the highest returning strategy available. Here is the part of this story that is both liberating and slightly infuriating. The simple, low-cost, evidence-based approach to investing has been publicly available for decades. It was not hidden, it was not secret, it was articulated clearly and compellingly by John Bogle, the founder of Vanguard and the creator of the first index fund available to ordinary investors. Bogle launched the first index mutual fund for retail investors in 1976. He argued, based on the available evidence, that most investors would be better served by simply owning the entire market at minimal cost rather than paying for active management that statistically failed to deliver superior returns. The financial industry's response was immediate and hostile. Competitors called the fund Bogle's folly. Industry executives argued that settling for average returns was un-American, that striving for excellence, trying to beat the market, was what investing should be about. What they were actually arguing was that their revenue model depended on investors believing complexity and active management were valuable. Bogle's simple, cheap alternative threatened that model directly. Today, Vanguard manages over $9 trillion in assets. Index funds represent the fastest-growing category of investment vehicles globally. The evidence Bogle cited in 1976 has only strengthened over the subsequent 5 decades. The simple approach won the intellectual argument comprehensively. It continues to win the performance argument year after year, and it remains, today, the approach that delivers the best outcomes for most ordinary investors. The 3 funds that cover almost everything a long-term investor needs. VTI Vanguard Total Stock Market ETF owns approximately 3,600 U.S. companies. Expense ratio 0.03%. One fund, the entire U.S. equity market. VXUS Vanguard Total International Stock ETF owns stocks from developed and emerging markets outside the U.S. Expense ratio 0.07%. International diversification in one fund. BND Vanguard Total Bond Market ETF owns thousands of U.S. bonds. Expense ratio 0.03%. Fixed income stabilization in one fund. A portfolio of 70% VTI, 20% VXUS, and 10% BND, rebalanced annually, covers the entire investable global market at a blended expense ratio of approximately 0.04%. That's 4 cents per year on every $100 invested, versus the industry average of $100 or more per year on every $100 invested in actively managed funds. Same market exposure, 96% cost reduction, no research required, no analyst calls, no complicated decisions beyond buying the same 3 funds every month. This portfolio is not a compromise. It is not settling for average. Over 20-year periods, it outperforms approximately 92% of actively managed alternatives because it doesn't try to be clever, and cleverness costs money that simple doesn't. Here is the practical framework for cutting through the noise and investing simply, cheaply, and effectively, starting today. Step 1. Ignore financial media entirely for investment decisions. CNBC, Bloomberg, financial Twitter, investment newsletters, market predictions, analyst upgrades and downgrades. None of this is relevant to a long-term index investor's decision-making. The signal-to-noise ratio in financial media is essentially zero for buy-and-hold investors. The market outlook segment on television is entertainment. It is not actionable information for someone investing in index funds for 30 years. The appropriate response to every market prediction is the same: continue your automatic monthly investments and do nothing else. No predictions change this response. No headlines change this response. No analyst upgrades or downgrades change this response. Ignore the noise entirely. Your returns will be better for it. Step 2. Understand exactly 2 things about your investments. What you own, the index your fund tracks. What it costs, the expense ratio. That is the complete knowledge requirement for an index fund investor. You do not need to understand the holdings. You do not need to understand macroeconomic conditions. You do not need to understand technical analysis or fundamental analysis or any other form of analysis. What does this fund own? The entire U.S. stock market. What does it cost? 0.03% per year. Those 2 answers are sufficient. Everything else is noise. Step 3. Automate everything and review annually. Set automatic monthly contributions. Set automatic purchases of your chosen index funds. Set an annual calendar reminder to rebalance. Sell slightly from whatever has grown above your target allocation. Buy slightly of whatever has fallen below. Annual rebalancing takes approximately 20 minutes, once per year. That is the complete active management requirement for a simple index portfolio. No daily monitoring, no weekly adjustments, no response to headlines, 20 minutes per year. Step 4. When someone makes investing sound complicated, ask why. Every time an investment product, advisor, or media personality makes investing sound complex, ask a simple question: who benefits from this complexity? If the answer is the person presenting it, through fees, commissions, advertising revenue, or the sale of their expertise, treat the complexity with appropriate skepticism. If the actual evidence supports the complexity, if there is a genuine reason your specific situation requires more sophisticated planning, evaluate it accordingly. Most of the time, the complexity serves the presenter, not you. Step 5. Read one book. If you want to go deeper than this video, and it's worth going deeper, one book covers the evidence comprehensively and readably. John Bogle's The Little Book of Common Sense Investing is the single most important book written for ordinary investors. It makes the evidence-based case for index investing clearly, accessibly, and thoroughly. It is short. It is cheap. Read it once. You will not need to read anything else to be a more informed investor than 95% of the people managing their own money. Let me be fair here, because this video is not an argument against all financial advice. It's an argument against paying for complexity that doesn't serve you. There are situations where professional financial guidance genuinely earns its cost. Complex tax situations, business ownership, significant stock compensation, estate planning needs, multi-state taxation. These situations genuinely benefit from a qualified CPA or tax attorney. Behavioral coaching. If you know from experience that you will sell during market downturns, a fee-only fiduciary advisor who charges a flat annual fee and helps you stay the course may earn that fee many times over through preventing behavioral mistakes. Major financial transitions. inheritance, divorce, sale of a business, sudden significant wealth. These situations involve genuine complexity that benefits from professional guidance. The key word in all of these is fee-only fiduciary, an advisor who is legally required to act in your interest and who charges you directly for their time, not through commissions on products they sell you. Fee-only fiduciary advisors exist. They are listed at NAPFA.org. They are a small minority of the financial advice industry, and for genuinely complex situations, they provide real value. For the straightforward situation, regular income, saving for retirement through index funds, long time horizon, the 4 sentences at the beginning of this video are genuinely sufficient. The confusion was never about your situation. It was about someone else's revenue. Let me say the 4 sentences one more time. Buy a low-cost index fund that tracks the entire stock market. Do it automatically every month. Don't sell when markets drop. Wait 20 to 30 years. That is the strategy, the complete strategy, the strategy backed by more evidence, more decades of data, and more real-world outcomes than any alternative available to ordinary investors. Everything beyond those 4 sentences is either refinement for specific situations or noise generated by an industry that profits from your belief that you need more than 4 sentences. The confusion was never yours to carry. It was manufactured, distributed, profitably maintained. You can put it down now. Open the account, buy the fund, automate the contribution, stop watching the news about it. That is all that was ever required.